Well, it's official. Nick T from the Wall Street Journal, the Fed's mouthpiece, just responded to the CPI crisis, or is it? We'll talk about what the bears and bulls are thinking, and we'll also talk strategy as well as some stocks that I'm looking at right now that I think could be well positioned for where we're heading. But first, we have to remember that what we talked about in this morning's live stream in the Meet Kevin Report 103 was that a 20% rally in the S&P 500 does not necessarily create a bull market. Well, that is the technical definition of one. Take a look at this. We had a bull market here in early 2001, towards the end of 2001, and the end of 2002. So, are we potentially, much like a bird flying into the window of a house, blinded by this now we're in a bull run classification? And are we blindly walking into a potential rug pull? By the way, a bird did actually just crash into my window. That's why I thought of that analogy. I don't know why I'm mentioning it. The bird's okay, but it was a little shocking to me because of these large glass windows here, and I'm like, oh, that was quite unexpected. But anyway, bird's okay, and let's see if we're going to be okay. So, beyond this 20% argument here, we need to understand some of what's actually happening with inflation. So, we have to look at the facts and the data first. So, let's start there. And that is, of course, where I like to write on here that on the 16th at 11:59 p.m., we're raising the prices on the AI course, the productivity course, as well as the real estate investing, the stocks, and the sales group. We're raising everything again. That is something we regularly do as we add content. And boy, we've got the entire team working on even more new lectures right now. So we've got a big lecture release date coming out that we're very excited to share with you. So check that out via the link down below, or just go to meetkevin.com, whatever is easier for you. So what do we have on this chart? Well, this is obviously pricing pressures here on inflation, and what we could see are two lines. Number one, we could see core. Those are going to be these gray charts right here. That's your core inflation, kind of where we sit right now. And then you have this headline inflation figure, which you could see had much more of a roller coaster up and more of a roller coaster down. That headline inflation falling pretty dang rapidly right now. Core inflation not falling super rapidly, but if you look closely, we could see that peak in core around September of last year, somewhere around that Jackson Hole time. And if you actually look closely enough, I know it's almost like you have to squint your eyes. That's where the bears laugh and go, yeah, you have to look so closely because it's falling so slowly. But the reality is it actually is falling decently. We are seeing disinflation at almost every different segment of the inflationary reports. Now, they might be a total lie and total BS, but what's actually driving core up? And it's worth noting what's driving core up. Well, there are two big things driving core up right now. So here's the fact. When you look at the goods chart of where goods inflation is coming from, it's coming from transportation commodities, less motor fuel. But if you actually look at this chart and you see that pink bar, you could almost say that if you take the highs here and the highs here and cancel it out with the lows here, you really got nothing. And I'm not trying to rejigger this chart or whatever. We're just trying to simply say, look, if you removed this pink bar of the last 2 months, you'd have almost no core goods inflation. And this transportation commodities, less motor fuel. That's a fancy phrase. It's basically your used cars, your new cars, tires, and parts for vehicles. Used cars really shot up because we still have a shortage of used cars. And even though leading indicators suggest that used cars should be coming down in prices, people still have the capability of paying for these vehicles. And so we're still seeing some volatility in vehicle spending and therefore vehicle pricing. Now, it's not to say you want to go through the CPI report and start ripping everything out. This is simply to put a magnifying glass on where are the problems. Well, this is where one of the problems is. And this is where the second problem is, which is your housing sector as well as your transportation services over here. So you still have a little bit of heat there related to, again, that vehicle segment. Otherwise, we're getting pretty narrow there on what's actually contributing to inflation. And when we take a look at what we're looking at the forecast for shelter inflation with, we can see we really just hit the peak. So all of a sudden, if you write down, okay, what's really driving inflation right now? If you really want to know, it is still, and it sounds remarkable, but it is still housing. Boy, I'm tired of talking about this crap. It is still used cars. It's not even airlines anymore. They're negative. And it is still transport services, which that one's been another volatile component. You could really see that one more clearly here by just looking at that lime green segment. We didn't see it last month, but boy, it's been a contributor for almost every single month with the exception of a couple over here over the last year. So the point of this is really to say broadly, once you ignore, not saying you want to, okay? I always get the comments, sure, Kevin, sure. Once you strip everything out, there's no inflation. Good one. No, it's actually, if you take out very small segments of things, that is narrowed categories, housing, transportation, cars, and I understand that's a big part of people's lives. But what is everything else doing? What is that super core sector doing? And it's actually growing extremely slowly. But you know what? Don't take it from me. Let's look at some of the facts and some of the data, because sometimes I feel like, people want to see the numbers on screen. They're like, Kevin, we don't just want to hear from you. We want to see the data. And I respect that. I totally respect that. So here it goes. CPI super core. In fact, smart people are critical, right? That's okay. It is okay to be critical. That's a sign of intelligence. CPI Supercore, which offers a highly imperfect proxy of Powell's preferred measure, CPI or PCE Supercore rather. So in other words, sort of a rough guesstimate based on our CPI to get to a PCE Supercore. What did we see for CPI Supercore? Just 0.2%. 0.2% annualized is 2.4%. That's fantastic. Last month, we were at just 1.2% annualized, which you could see here, that 0.1% in April. So in other words, again, you're taking out some of those really volatile components like the autos, and then you take out just housing. What are you left with? Virtually no inflation. If this number was hot, the Fed would be able to say this phrase, and I know you've heard it before. The Fed would be able to say inflation is broad based. Inflation is pervasive. And when inflation is pervasive and broad based, guess what happens? We hike. And guess what Bloomberg economists are projecting now? A full stop. I kid you not, Bloomberg is now forecasting a full and complete stop to any kind of rate hikes. Now, this stands in contrast to what Nick T says. And so, how do we reconcile some of this information? Well, first, I want you to look on screen here. I want you to see this full stop headline. This is literally just Bloomberg.com. You didn't have to pay a dime to see this. Look, you could learn about Trump's indictment. Oh, we're supposed to go here. Okay. U.S. inflation reports suggest Fed pause will become full stop. Now, I'm already going through some of the details here, so we're not going to just read you an article. We want to give you the bottom lines and respect your time. And the point is, the data we got in this report reiterates a complete pause. And this is consistent with history that the Federal Reserve does not want to send the signal of being wishy-washy with rate hikes. That would be a real big problem. Markets, however, are not yet pricing that full stop in. And this is actually quite fascinating. Look at this. Current rate hike probabilities are sitting, well, we're basically committing to a pause for tomorrow. That's no doubt. This is about an 88.5% chance of a pause. There should really be no surprise or shocker tomorrow that we'll have a pause tomorrow. That's almost guaranteed at this point. But then what else you have? Well, then you have Nick T's response. Where is it? Oh, I don't think I saved it in here. Okay, I'll pull it up really quick. But tomorrow, or rather July's rate monitor. Now, this is an interesting one, okay? Because think about this. This is going to tell us what is the market pricing in for July. And right now, for July, you're still actually relatively close to a coin toss. In fact, it's risen just in the last 32 minutes here, up to a 62% probability that we are going to get a hike next month. Now, why would it have risen from a coin toss to about a 62% probability of a hike next month? And why is Kevin and Bloomberg saying not a chance of a hike next time? In my opinion, it's because of this article from Nick T in the Wall Street Journal. Again, I'll save your time. I'll give you the bottom line. Bottom line here is actually the first paragraph. I read the whole thing. I'm not just reading the headlines. I read the whole thing, but the bottom line is really the first paragraph in this one, honestly. Fed officials concerned about stubbornly high inflation could lead them to signal that they are prepared to lift interest rates again this year, even if they hold them steady on Wednesday. Of course, the Fed is going to say that, because if the Fed doesn't say that they're willing to raise rates again, well, then it's going to send inflation expectations up. And what are inflation expectations doing right now? Well, the 5-year inflation expectation has been a little volatile today, but it's actually remaining relatively anchored at 2.156-ish, relatively low. It's not a super bottom like what we've seen in the past few weeks, but you could see how low anchored we are in just the last 6 months. This is fantastic. This is where you want to be with inflation expectations. So, point is, Core inflation, low. Inflation expectations, low. History saying stay at a pause. All of that, great news reiterating staying at 5%. Obviously, you get a bad report, things change. Barring a bad report, which today's report was not a bad report, there's pretty much along expectations. What do you have? You have the Fed staying paused. All of those are leaning towards that. So, how do we allocate in this sort of market in a not personal financial advice manner? What stocks should we consider? Now, I want to be clear about this. Even though I'm a licensed financial advisor and I'm streaming to you on this beautiful webcam that you could learn about as well by going to metkevin.com/webcam, or you could get life insurance in as little as 5 minutes by going to metkevin.com/life. Or you can learn everything about me or the other services that I offer in the courses. And yes, I'm a fund manager, ETF fund manager, whatever, by going to meetkevin.com. Scroll around, you can see everything you need to know. Well, aside from all of that and the paid promotions, I think there are some stocks that aren't actually seeing the love just yet. And I want to give you a quick thesis on some of those, mostly as a thank you for making it to this part of the video, because I suspect a lot of people actually don't. But quite frankly, that's okay, because then you get the good value back here, okay? So what do we want to look at? So obviously here's Tesla, up 3.28%. It's starting to get a little expensive. Now we're sitting over somewhere around 2.15-ish on a peg ratio. It's starting to get a little pricey. So where are the potential opportunities and risks? So obviously you've got Enphase over here. What do you have with Enphase? Well, the problem that you have with Enphase, unfortunately, is that Enphase is really a real estate related play. And when Enphase, okay, come on there, I just want to make the window larger. I don't need to enter a password to do that. Okay. When Enphase does well is when the real estate market does well. And the real estate market had its slowdown between May of 2022 and December of 2022. Which what's interesting is Enphase hit its high in December of 22, and it actually was closer to a low in May of 2022. This indicates there's about a 7-month lag in this. Now, what's really fascinating here is that we are coming up on about 7 months. We're about 6.5 months into the year of real estate prices actually trending up again. And so there's an argument to be made that Enphase could see a nice bounce from this level, about 180, to the mid 200s pretty easily, and then on from there, especially as we get to bidirectional charging, tentatively Q1 2024, though I always expect delays. And of course, we get more battery deployments. Yes, net energy metering is probably going to be something that's going to hurt for a while, because it does increase your cost of getting into solar, especially in places like California. And obviously, interest rates make it a little harder to finance some of these panel systems. But the return on investment for solar is still pretty dang solid. And as the stock market rises and the real estate market rises, I wouldn't be surprised to see some energy investment here again. So here's a potential play. What's another potential play? Well, another potential play that's not getting a lot of love right now is Ubiquiti. Now, I want to be transparent here. I have personal exposure to this stock that I initiated right around $165. I also have personal exposure to Enphase, so I want to be very clear. And these aren't, personal recommendations for you. You have to figure this out yourself. These could be wrong. But I'm just looking, when we're looking at stuff like this, like Nvidia going off the freaking charts, I'm like, where's the opportunity left? Even AMD, even though it's down 3% today, it's like things are going off the charts, right? So where are opportunities left? I am fearful of PayPal. I think PayPal could pull off a Meta, but I think the risk is too high thanks to Stripe competition. Its debt load, I don't think they're going to transition to dividends. Their debt load isn't that high. They have excellent cash flow, excellent free cash flow, but they really need to move to dividends and become a value play. And right now, they're still a growth play, and I don't want to hang out for that transition. But if they transition to a value play and they just provide great service to their customers despite the social media risk, there could be some opportunities here. But Ubiquiti is interesting because they really got marked down substantially due to over ordering inventory and now having too much inventory, having to mark down some of their inventory. The risk here is that those markdowns have to continue, and so some of their balance sheet continues to get a write down. But you're trading right now for somewhere around September levels of 2020. You're not quite yet at the 123 COVID levels, right? But you're pretty dang low. So absolutely still some downside downside risk here for Ubiquity. This is a thinly traded stock. It's also a stock that has a lot of concentrated ownership. The founder of the company owns like 90% of this company, something to that effect. So there's a lot of risk in, is the founder going to Elon Musk? Yeah. But what's interesting is you don't actually have a lot of institutions paying attention to this company, and their margins are remarkable. I mean, these are NVIDIA like margins for routing equipment. And I think the more we get into artificial intelligence, virtual reality, augmented reality, the more demands there will be on home networking, prosumer networking, enterprise networking. And Ubiquity is a fantastic play for that, in my opinion. Now, then you also have Intel. Obviously, there's talk about them with ARM. That's not a big deal with the ARM IPO. Tentatively, it's drawing some attention to the stock. But what I think is a bigger deal is their foundry setup. I think this is if they build it, they will come. If we build it, they will come play. And this is a company that over the next 3 years is going to be one of the first companies to get access to the brand new manufacturing machines that ASML is coming out with, even before TSMC. Intel will be manufacturing 3 nanometer chips. You've got some huge opportunity and first mover advantage here, especially in their foundry services, which nobody seems to be underwriting right now. A lot of this company, when you look at the fundamentals of the past, you're really looking into a foggy lens. Whereas I think the future here is manufacturing and no longer strictly chip design. People look at this as like, oh, well, Apple dumped them as a processor creator, whatever. Who cares? I don't even care if Intel makes a single chip again. Obviously, they'll use that to transition and their revenues in that sector may still decline. For me, though, this is a play that long term, it's a foundry play, a manufacturing play. So these are some I'm watching. I'm also watching Etsy on a potential rebound. We're relatively close on the low side of the fibs here, but also from a fundamental point of view, this is a company that if business margins for small businesses or creators or whatever designers go down, Etsy margins don't. And that's a beautiful thing with Etsy, is that Etsy ultimately maintains margins through selling services or selling space to their customers and taking a gross merchandise volume transaction fee rather than selling their own products. So less exposed to inflation. And you have to be careful. Is it potentially a COVID play, right? So that gives you a wrap up. If you like my perspective and you want to hear how we come up with this fundamental analysis, check out those courses on building your wealth. Link down below. They've all of that information. And we'll see you in the next one. Thanks so much. Bye.